Good afternoon, everyone. I'm Jay Sanderson, the CEO of the Jewish Federation of Greater Los Angeles. I want to welcome you to Where Do We Go From Here, Investing in the Age of Coronavirus. We're excited that there are over 800 people on this virtual experience, and we're going to be able to learn from the wisdom of Howard Marks, Director and Co-Chairman of Oaktree, who will be in conversation with the Chair of our Finance and Business Network, Jordan Bender, the Managing Director of Goldman Sachs. I wanted to spend a moment or two to talk to you about what our Federation is doing during this extraordinary crisis. We recognize our own vulnerability every day now, working from home and living from home, and keep our families and our friends and our communities safe. But our community is extraordinarily vulnerable at this moment, and the Jewish Federation addresses our greatest needs 365 days a year. So when this crisis happened weeks ago, we made sure that we were on top of every issue that we needed to address, including food instability and taking care of our most vulnerable. Think about a Holocaust survivor, someone who recently lost their filled with stories of people that need the Federation to address their needs. Whether it's our community hotline, whether it's our emergency cash grants, our no interest loan program, our Ezra network with social workers taking care of people who need constant support and help. Our Jewish Federation is on the ready in good times and in this extraordinary crisis. And we depend on your support to keep that work going. So thank you in advance for the support you give the Jewish Federation to make sure that we can be the foundation of the Jewish community. I'll turn it over to Jordan Bender, who will begin the conversation with Howard Marks.
Thank you, Jay. I hope everybody can hear me and the sound is coming in clearly. If not, I'll have to have somebody text me. But well, first of all, again, thanks for everybody who's participating. Howard, on behalf of the entire LA Jewish Federation, the hundreds of friends and admirers that have signed up for this Zoom call, thank you. We're so grateful for your time, for you offering to share your wisdom with all of us during these most extraordinary circumstances. You and your partner, Bruce Karsh, and your other partners have really put Los Angeles on the map for investment expertise. And, you know, Warren Buffett said, your memos are the first thing he reads when he gets them, and that he always learns something. Your books have been called must-reads by Buffett, by Ray Dalio, by many national newspapers, which is just incredible, Howard. And again, we're so grateful for all your wisdom. About 25 years ago, the same time you founded Oaktree, you actually led the LA Jewish Federation Financial Services Division. And I wanted everyone on the call to know that the Jewish Federation has been important to you over many years, that philanthropy has been something that's been dear to your heart. And, you know, on a personal note, you've been a friend and a mentor for that many years. And I've had a front row seat to your leadership working with you at the Federation all those years. So thank you again, Howard.
I just want to say, Jordan, that, you know, my wife and I came out to LA on March the 6th. We didn't expect to still be here. We didn't know about the sheltering in place and all the other many things we'd be doing to cope. But LA has provided a nice place to spend this period. And enable us to make the best of a bad situation. So I'm glad to repay the favor by speaking to the LA community.
Well, we're glad you snuck back into LA as a resident and are realizing all the great benefits you knew before. Where I think, you know, maybe we'll have an increase in population and growth again after this terrible crisis. But let's just dive into the purpose of this call, which, you know, we titled "Where Do We Go From Here?" And, you know, based on the many questions we received over email, the majority of them fit into four categories. And I'm just seeing this. We're putting up something that you wrote in your memos, in your 2005 memo, was really the start of the first section about cycles and the warning signs we're in. So I thought start with this kind of famous writing of yours. But the four categories are really the following. First, we're going to talk about the psychology of investing during the coronavirus, which you touched on, quite a bit in your most recent memo, Calibrating. Second, your impressions so far, Howard, of government intervention, your views on both the Fed and Congress and how they may affect the present and the future investment landscapes. Third is your views on some of the major asset classes people were asking about, equities, the credit markets, and the real estate market, kind of the three major ones. And then finally, your outlook for the economy and investing opportunities after the coronavirus has either left or has been, in some ways behind us or much more subdued, and where you see the long-term opportunities and potential long-term impairment in the economy. So I want to begin, you wrote about John Kenneth Galbraith being one of the inspirations for your thinking, and about his most influential book, A Short History of Financial Euphoria. And again, shortly into your famous books about that included your memos, you've talked about this sort of the emotion and psychology about euphoria in markets. And Howard, we just concluded the longest bull market in history, a very strong and long economic recovery. Unemployment was at 50-year lows. Interest rates and inflation were under control. And then the coronavirus black swan developed into this global pandemic. So, today we start with, your last memo. You had said you set a personal record for memos in 1 month. Where are we at this moment in the cycle, and how do we adjust to the speed in which markets moved compared to the past, Howard?
Yes. Well, first of all, Justin, Jordan, the things that are going on right now are not what you would call cyclical. They are, unusual sunspot type occurrences, or you said black swans, things that could not be predicted. But today's events are not part of the regular up and down motion that we associate with the word cycle. The question really, if you go back to the slide where you quoted me and talked about the fact that you can't have bust without booms, and consequently the way to deal with these things is to understand where we are in the process. I always start off, Jordan, by going back into history a little bit, and to say that the key to being prepared for the recent events lay in understanding where we were in the cycle. And, I wrote a memo about 20 years ago, and I'll be referring many times to my memos, and Jordan mentioned them in his introduction. And I just want the listeners to know that, I've been writing for about 30 years, and the whole 30 years worth are available on the oaktreecapital.com website under the heading of Insights. And for anybody who's interested, the price is right because it's free. I wrote a memo about 20 years ago entitled, "You Can't Predict, You Can Prepare." And now I didn't make that up. That was the tagline of I think it was the Mass Mutual Life Insurance Company at the time. But I think that the title is very provocative and helpful. You can't predict, you can prepare. What does that mean? That, on the surface, that sounds contradictory. It sounds like an oxymoron. But here we are with the coronavirus. Almost nobody predicted it. I mean, brilliant people like Bill Gates predicted that we would have a viral pandemic one day, but I don't think you could say he predicted this one, or certainly that it would come at this time. Right. So the coronavirus was unpredictable. And the question is, could you have prepared for it? My belief is that you could. And the way one would have prepared is by understanding where we stood in the cycle. So if you think back, let's think back 3, 6, 12 months. Where were we then? First of all, we were in the 11th year of an economic expansion, the longest one in history. We were in the 11th year of a bull market, the longest one in history. So while these things are not necessarily limiting, it's possible to say, things have gone well for a long time. Maybe they're not going to go on as well forever. What I was telling people in the last few years is that we were living in an uncertain place, because I think that geopolitical and political events have made the world more uncertain than it used to be. Prospective returns on investments were low. Interest rates were the lowest in history. Bond yields were the lowest in history. And these things have an impact on the returns on everything else, the prospective returns. So prospective returns were low. Asset prices were high, not crazy high, not a bubble, but above average. And most importantly, because prospective returns were so low, many people were engaged in what I call pro-risk behavior in order to try to achieve high returns in a low return world. The average US institution needs about 7% a year to make the math work, but interest rates were 1, 2, 3%. Stocks were expected to make 5 or 6%. It's hard to get to 7 with stocks and bonds. So most of them were doing riskier things, leveraged activities, private equity, low quality investing in order to get a high return in a low return world. And that makes the world a risky place. So that was my description of the world. And that convinced me, not 2 months ago, but several years ago, meaning I was too early for a long time, to emphasize defense over offense. That was really the cyclical background.
Right. And then, I think 2 memos ago, in which maybe it was Which Way Now, where you laid out the positives and negatives, generally leaning more towards the bear case. And then, of course, your more recent memo, Calibrating, you did say, and it was very good timing, maybe it's time to play offense. And I'm wondering, Howard, I remember an article many years ago in the New York Times, which said, bad news has, 4 to 5 times the psychological impact of good news. And here you've had this double dose of bad news with, people's health and wealth being affected at the same time. So maybe it's 10 times the psychological impact that we normally experience. How does one go about investing in this kind of environment? How would you suggest people invest when the news is so terrifying?
Well, a couple of things I have to say, Jordan. First of all, did you know 6 months ago, 12 months ago, 24 months ago, that we were high in the cycle and that the upcycle was getting old? And did you put on some defense? If so, you were slightly prepared for what has happened. Nobody was insulated, but you were a little bit better prepared than others. Now that the virus has arrived and it has knocked down the economy and sent us all home, and it has knocked down stock prices and bond prices, now the question is what to do. So you remember what I said about my view of the world in the past. Uncertain, low prospective returns, high asset prices, risky behavior all around us. That convinced me to be defensive. Now, the riskiness of the environment, everybody understands. Asset prices have fallen. That has caused prospective returns to rise, and most people are not as interested in risky behavior as they were 6, 12, or 24 months ago. In other words, in all these regards, the world has gotten better. So I wrote a memo and I talked about the world being more hospitable. And, you know, I got a response from one of the colleagues that I asked to read it. Well, you better define hospitable, because most people think the world's gone to hell in the last 2 months. And the answer, my answer is, when prices are lower and people are not engaging in risk behavior, the market has become more hospitable. So that's my feeling. You know, I quoted from a friend's newsletter. He used a great title that I can't get rid of from my mind. He said, when it comes time to buy, you won't want to. Right. In other words, when the buying moment arrives, the world will be a mess. But if you think about it, it's because the world is a mess that it is the buying opportunity. If the world wasn't a mess, prices wouldn't be as low as they are. So the point is that a few weeks ago, 3 weeks, I guess it was, on March the 23rd, we reached the low. And everything was much better than it had been a few months before that. It only felt worse. But when people were oblivious of the risk, I thought it was time for defense. Now that everybody's aware of the risk and prices are much lower, I thought that the defense was not so much required. So I wrote the memo that you mentioned. I see you leaning in because you want to talk. But, I wrote the memo that you mentioned. And, you know, it was picked up in some newspapers. And a lot of them said, well, Howard Marks says it's time to be aggressive. That's not what I said. No. What I said was, if 6 or 12 months ago you were defensive, now you don't have to be as defensive. So in choosing the balance, which I think is the key for every investor, in choosing the balance between offense and defense, now it's time to be perhaps neutral, not so defensive, neutral, or maybe even a little on offense. But that's the way I look at everything. That's why I chose the word calibrating, because I think we have to calibrate our risk return position, our offense defense position, relative to what's going on around us.
I was going to ask, you know, because you've been talking now about risk and assessing risk, and in many of your memos you talk about, you know, the things that are unknowable, and you know, many aspects of this virus are still unknowable, whether it comes back, whether there will be a vaccine, et cetera. How do you and how does Oaktree go about assessing risk and making investment decisions when there are certain factors that are unknowable?
Sure. Well, that's a great question. That is the key question, Jordan. I've been working all day today on a new memo, which I think I'll have out tomorrow, called Knowledge of the Future. And I chose that title because the words knowledge of the future is an oxymoron. There is no such thing as knowledge of the future. All we can do in thinking about the future is number one, extrapolate from past experience, and number two, make guesses. But we don't know anything about the future. In the memo you referred to 2 memos ago, Which Way Now, I laid out the bull case and the bear case, the optimistic case and the pessimistic case. And, you know, since there is no such thing as knowledge of the future, I said there is no intelligent way to choose between them. This is an interesting point, in my opinion. When we read those cases, and I encourage your audience to go back to this memo, two weeks ago, and read it over, and read the optimistic case and read the pessimistic case. Now, make believe you didn't know what happened over the subsequent 2 weeks, but you know, which one would you have chosen? And in my opinion, most of us choose between the optimistic and the pessimistic, not because of the persuasion of the facts, but because we are inherently optimistic or pessimistic. We are biased. We all have our biases. And, you know, Jordan mentioned that in that memo, I lean toward the bear case, would you say, Jordan?
Yeah.
That's because I'm a warrior. Mm-hmm. I'm a warrior. I'm not a dreamer. I'm not inherently an optimist as to the markets. I feel that it is my job to worry on behalf of my clients to keep them safe. What that means is I have helped them shelter from the past crises, but I have not helped them maximize their gains from the past booms. That's the choice we're stuck with. So the point is, I think people choose between the bull case and the bear case because on the basis of their biases. And you know, you read 1,000 things now, and there's all this news about the coronavirus and the economy and the oil situation and the market behavior. We read about all these things and about the present events and about the future possibilities. And it's quite clear to me what happens when we read one. If let's say you're a warrior like me, you read one and it is cautionary. You say, aha, I think that's right. That's a good point. If you read one which is optimistic, you say, well, I think they're being too bullish. In other words, you don't take these facts in as if they're all equally likely to be germane. We lean toward the ones that agree with our biases.
Yeah. Well, I think there's a lot of studies that human beings are wired towards negativity, like going back to the caveman, which is why, even during the 11-year bull market, individuals and institutions were actually net sellers of equities, and there's been a, tremendous movement out of stocks as the market's gone down. So it'll be interesting to see if people can overcome some of their general leanings towards negativity. And as you say, switching to offense. Just to switch gears here for a second, Howard, maybe let's talk about something we had a number of questions on, which was, how the government is handling this crisis. And, there's been, dramatic measures by both the Fed and Congress. There have been, other phases of intervention that have been written about. I'd like to get your thoughts on how you think those have worked so far, if there's some unintended consequences, what more you think we might need to do to keep the economy afloat before things start to normalize.
Well, let's go back to what we said earlier, or I guess I said earlier. Mm-hmm. We understand the present and the future through the context of the past. And, we were very fortunate when the global financial crisis struck to have Ben Bernanke chairing the Fed, and Ben was an expert on depressions, actually, and Tim Geithner, who was a brilliant economist. But if you're knowledgeable about the Great Depression, you understand that for some reason the government withdrew liquidity from the economy, and that exacerbated the pain and contributed to the fact that the depression went on for about 10 years. Then, as I say, Bernanke helped us in the global financial crisis, and he and Geithner and also Hank Paulson before him helped to develop a number of tools and tactics that contributed to our recovery from the global financial crisis. And I think that the government handled that very well, and they were learning on the fly, but the results were very good. Now, Steve Mnuchin, Secretary of Treasury, and the Fed, Jay Powell, have the benefit of what Geithner and Bernanke and Paulson did only 12 years ago. So in 08, it took several months to develop the tools with which they fought the global financial crisis. And this time they were able to unleash them in a matter of just a couple of weeks. Remember that the stock market reached its high on February the 19th, and the word of the stimulus package started to come out on March 23rd. So only 4.5 weeks later. I think that the people in charge reached the conclusion, which I think is the right conclusion, that you have to err on the side of doing more rather than less, faster rather than slower. And, you mentioned Bruce Karsh, Jordan, and back around March 18th, I think it was, Bruce and I were talking and discussing the possibility of a global depression, because with so many millions being thrown out of work and so many businesses closed, we felt that that was a good possibility or a bad possibility. But now that's off the table because of all that the government has done. And now we're talking about a V-shaped recovery. And the main debate seems to be regard to whether we'll get back to the 2019 level of GDP in 2021, or whether it'll take to 2022. And there are differences of opinions, as there have to be, because nobody exactly knows how these things work. But to be talking about a return to the 2019 level of GDP is a great thing to be thinking of. So the answer is, if anything, they erred on the side of doing more, not less, faster, not slower. Now, your question is whether there will be a downside. And first of all, one of the most important things that I can say to this audience today is that if you've never lived through something before, you can't possibly say you know how it's going to end up. And I don't know how it's going to end up, and I don't think anybody can say they do. And so when we used to debate whether it was okay to run a $100 million deficit. This year, the deficit is probably going to be $3.5 trillion or more. And that's in addition to the Fed pumping up its balance sheet by 4 or 5 trillion. So close to 10 trillion of stimulus, rescue, support, bond buying, and so forth this year. What is the effect? And I've got the answer, which is nobody knows. Mm-hmm. But you would think that there would be ramifications. And what could they be? Well, first of all, I don't want anybody to run out and take action on this, because I can assure you that I don't know what I'm talking about. But you would think that if another 10 trillion is pumped into the financial system and the economy, that we could have inflation. On the other hand, of course, many nations have been trying to create some inflation. Inflation is not a terrible thing, and most countries have been aiming for 2% inflation in recent years and unable to produce it. So clearly, if we knew how to produce it, we would, and they haven't been able to. So that tells me that it is mysterious and unpredictable. We could have inflation, we could have weakening of the dollar, we could have a diminution of the dollar's role as the world reserve currency. Those are the main things to worry about. Whether they'll happen, nobody has any idea, including me.
Would you be pleased to see more? Would you be pleased to see, let's say, a massive infrastructure program like now Congress is talking about, which they had been discussing for years, but maybe see the urgency at this point?
Well, look, number one, I think our infrastructure is crumbling. So I think we need it anyway. And number two, I think it would be a good thing for society. There's a new theory out, Jordan, called modern monetary theory, which basically, to oversimplify, holds that deficits and debt are not a bad thing. Federal deficits and national debt are not a bad thing. And that if the government can borrow, and look, the government can borrow now at 1%, right, or 2%, maybe for long bonds. If the government can borrow at 1 or 2% and build something which has a return of 5, 6, 7%, that is a return to society, it probably should, and that's a good thing. And one of the things I want to mention, and I don't know if the people in the audience have ever thought about this, but that the accounting that the government uses is highly deficient, because if my company gives a $100,000 raise to each of our 1,000 employees, then we add, that's $100 million expense that reduces our profits by 100 million. But if we buy a building for 100 million to do our business from, that's not an expense. And it doesn't come off our profits. That is an investment, and we depreciate it over time, but we expect to make a return on our investment. In the government, the accounting does not differentiate between current expenditures for expenses and expenditures for investment, which should produce a return. So I think that it is desirable, and I think we should have an infrastructure program. And two of my friends from New York were recruited to lead the infrastructure program when Donald Trump was elected, and I think they kind of gave up 15 months later when it became clear that nothing could be done.
Yeah, well, it'll be interesting to see our perception of what we need for infrastructure too has probably changed, which we can get into in a minute. You mentioned buying a building, so let's talk about the different asset classes, because the equity markets and the credit markets and the real estate markets will all have kind of different cycles here, or different investment results or output. So maybe just walk us through, if you maybe want to start with the stock market, then the credit markets and the high yield market, which very well. The difference between investment grade credit and high yield is quite dramatic today. And then the real estate market, which has a lot of complexities, given people getting comfortable working from home and not being able to pay rents and shopping and all those things. So I know that's a lot of stuff to cover, but I know that's definitely on people's minds. So have at it, Howard.
Well, thank you for that easy question, Jordan. First, let me say that, let's say 40 years ago, if we go back to 1980, as I recall, the world felt like an unchanging place. We felt the world was pretty much the same from year to year, a stable backdrop, I think of it as kind of a stage set that didn't change. And then we had events play out over the cycles and throughout the world in front of that unchanging backdrop. The world was stable. Now, of course, the world changes every day, and we don't expect it to stay the same. And I think that in many ways, change may have been accelerated by the virus, and we'll find out exactly how. That's just an intro. But I mean, the point is, we can't count on the assumption that the things that used to be such and such a way in the past are still going to be that way in the future. You mentioned real estate. That's a great example. I'll come back to that. But first of all, let's talk about the stock market. Now, the S&P 500 was about 3380 on February 19th, which was the high. And then it got down to about 2340 on March 23rd, which was a low, down 34%. And by far, the fastest decline of that magnitude in history. And by the way, Jordan, you mentioned that we lived through, and I mentioned that we lived through the world's the longest bull market in history. But then we had the fastest transition to a bear market in history, and then the fastest transition back to a bull market in history. So we had a decline. We had a decline of 34% and a rise of 25% or so, each in just a matter of a couple of weeks. Things that used to take years. So clearly, we have a high degree of volatility and unpredictability. Now, so stocks. Stocks now are up about 23% from the bottom, and they're down about 15% from the high. On the one hand, they're cheaper than they used to be. On the other hand, it seems to me somewhat inadequate a response. I mean, we have this massive thing called the disease. We have this massive economic response. You know, we historically the record for weekly new unemployment claims was 695,000, and that in the last 2 weeks we had 6.6 and 6.9 million, 10 times the record 2 weeks in a row. So you know, the economy is a shambles, and it seems clear that the second quarter GDP decline will be by far the greatest in history. So how can the stock market only be down 15%? On the other hand, and there's always two hands, at least two hands in the investment business, you know, it sure looks like the Fed is going to bring us back and produce a V-shaped recovery. And as I said, get GDP back to the 19 level in 21 or 22. You know, we can split hairs, but if it's going to be a year or two until the stocks get back to the 2019 level, I would say that the 15% decline that has been experienced is not sufficient to reflect that. And if I think stocks may be okay, but I think that the return prospects over the next year or so are moderate. And if you look at the PE ratio versus history, and you compare the fact that earnings are way down this year and maybe will still be below the 19 level next year, I think that on a PE ratio, stocks are not cheap. So maybe okay, not cheap. You asked about high yield bonds, and we've seen quite a change there. Now, maybe I feel a little better about high yield bonds because that's my specialty. But if you go back 2 months, or just over 2 months, I was preparing a presentation for a client who asked me for advice. And at that time, high yield bonds, if you leave out energy, and you know the energy sector is a mess because the price war between OPEC and Saudis and Russia. If you leave out energy, high yield bonds were yielding 3.5%. 3.5%. Now, when I started in '78, started Citibank's high yield bond fund, they yielded 12.25%, and now 3.5%. Today, now and then when the markets went to hell in mid-March, the yield on high yield bonds got back up to about 10%. Now, 3.5% was what I would call a penalty return. You weren't being rewarded; you're being penalized for investing in the asset class. But 10% is quite a reward. And since then, since the government announced their program in the week of the 23rd of March, and since the stock market's been working higher, improving sentiment, the yield on high yield bonds has been working its way down. And today, I think it was down to 7.5. Now, 7.5 is still a good yield, and it's still better than 3.5. But I liked it when they paid 10 better. I think that if you're an individual who wants an income, and you can find a capable manager or fund, you can invest in those bonds at 7.5. They'll probably put in a few energy bonds, which will pull the yield up. And then you have to take off the fees. They don't do it for nothing. And by the way, I don't do it for nothing either. And the likelihood of some defaults, but you'll still have a reasonable rate of return if you buy high yield bonds today. I'm not saying whether they're going to go up or down from here, but I think I'm only talking about the adequacy of the yield. Then, Jordan, you mentioned the subject of real estate, which is a really interesting subject. And it brings me back around to what I said about the world not being an unchanging place. So here we are. I've been in my house in Los Angeles for essentially 5 weeks. I think you probably have too. And yep. Most of the people in the audience, I hope, have been at home and keeping safe. And you know what the shocking thing is that it's not so bad. we have most of the things we need. By the way, I left all my crap in New York. I came out here for what I thought was 5 days, and I'm still here. My crap is still in New York, and I'm doing okay. So it teaches us how little of the treatise that we accumulate we really need, and maybe this has implications for the extent to which people will consume in the future, or you had that Galbraith quote up about the shortness of memory. Maybe it'll all bounce back. Nobody knows. But we don't need all our stuff. We do well living at home. I think I got 99% of the work I would have done in the office, I've gotten done at home. I save an hour commuting every day, and I don't have to leave my desk for lunch. There's another hour. So I think we're pretty efficient at home. And some of us and some businesses are going to conclude that they don't need offices, or as many offices. Or if you have a certain number of employees, you say, okay, you come in half the week, you come in half the week, and we only need half as many offices. So that's an example. Now, nobody knows what's going to happen with the office business, but I think you have to ask questions about whether we're going to use as much office space in the future as we did in the past. Now, the extreme example, of course, is real estate for retail. And, the bricks and mortar retail real estate was in a terrible decline before. And much fewer people were going to the stores, and the malls were really doing poorly. And this, of course, has accelerated that, and the malls and the stores are closed, and we're still surviving. And the online shopping is way up. I was speaking to a friend the other day whose company's online sales are up 4 times from the pre-crisis level. So this is probably going to accelerate the demise of retail real estate. There'll be a bounce when the economy comes back. It'll bounce, but it probably won't bounce back to the 2019 level, and the rate of deceleration or decline from here will probably be greater than it otherwise would have been, because we've learned not to go in the stores. Or there's always another hand. Or will people celebrate their newfound freedom by running to the stores and shopping? And the answer is, who knows? There are plenty of areas where we know that the future is not as bright as the past was, or as the future was expected to be. But in these areas, the prices of assets are down. That always happens. And that's not, so the question is not, is the future better or worse than it used to be? The question is, are the prices down more or less than they should be to reflect the deterioration of fundamentals? And what will that be? So, just before I put my first book out, I had lunch with Charlie Munger here in LA. And when I was getting up to leave the lunch, he said to me, "Now just remember, none of this is meant to be easy, and anybody who thinks it's easy is stupid. And, making money, big money, through investing is not easy, nor should it be expected to be."
Yeah. It's funny. My wife often reminds me, Howard, that, she married me for better, for worse, but not for lunch. So I think she's quite anxious for me to, at some point get out of the house more frequently. But I did know things had changed when my teenage daughter stopped, looking at her phone at dinner. I felt like that was maybe the time to start buying stocks again. We had seen some sort of change in behavior. It's interesting, the real economy sort of differs from the S&P 500. And, back in 2008, we look at the components of the S&P, and I think before the financial crisis, I'm not exactly right, but something between 30 to 40% of the companies were financial services and energy companies. I think the oil stocks were down to 2% recently as waiting in the market cap. And, our CIO, Charmine, often reminds me that, you can't charge your phone if we don't have some energy. You can't just do it all with clean energy. But, it's interesting. A lot of the S&P companies today, the big components are technology and healthcare companies, which are thriving, and roughly half the S&P. So I'm curious to know, again, where you see some of the long-term opportunities in terms of sectors, investments in healthcare, investments in technology, whether you'll continue to see this sort of smaller, market cap companies, be it energy or other sectors that might be worse off.
Well, Jordan, unfortunately, my answer is you have to ask Charmine. Because, Oaktree is not active in the stock market. And I do not concern myself with whether tech or healthcare stocks will be up versus energy and finance. So I don't mean to be dismissive, but I really can't contribute anything on that subject.
Yeah. What about this idea? One of my good friends asked about, innovation is generally done in small groups. And I talk about sort of I think, remember when they were talking about the Apple teams, the optimal group was like 10 to 15 people. Can we have the same level of innovation if we're all working at home? How do we sort of, create that, we're the smartest person in the room isn't smarter than the whole collective.
Well, I think that's a good point. And when we think about the permanent changes in society, I think that's one of the things we have to consider. Because I do think that there's important benefits to be gained from getting together with others and exchanging ideas and pushing back on their ideas. And that's how you have that aha moment. And I do think we stimulate each other. So, I think we will gravitate toward each other. I don't know about you, Jordan, but I've never felt that I got as much out of a phone call or an email as I did from sitting down in person with speaking with someone. So I think that, we don't have to, historically, we've worked together all week, every hour. Maybe it's not necessary. And maybe we can work together half the week and have 80% of the innovation we used to have and exchange. But I think your point is a good one. And I do, hope that we can continue working face to face. Yeah.
I like someone smarter than me, which is most people said, they like the term physical distancing better than social distancing, because we're still socializing through Zoom and conference calls. In fact, there's a certain intimacy to it. And like you said, I think a certain productivity enhancement from, maybe fewer distractions, although, there are some benefits obviously from, being with your colleagues and
what did you call it, Jordan?
Physical distancing, as opposed to social. I think we're physical distancing, but, we're social beings. And I think we need to, get that, connection. We need to keep those connections with people. It's
right
to our race. Right. Let me I think conclude. You've really given us a fulsome circle of advice and walked us through kind of a lot of your thoughts about investing and about the current environment. I want to sort of end with just talking about philanthropy a little bit, Howard. And this is a time when many charities are in need of a lot of help, and you've been incredibly charitable, specifically charitable to Jewish organizations over the years. And I just want to talk about, or have you talk about, the importance of charity and how you think about it, especially in times like this.
Sure. Before I do that, I just want to apologize to everybody for the length of my answers. But there are no easy answers in our business, and I'd rather give you your money's worth and a fulsome explanation. Jordan, I think that charity is a great thing, and philanthropy and sharing with others. It's a cornerstone of the Jewish religion, of course. The greatest form of charity is anonymous charity. So that always reminds me of the guy who stands up in shul and says, "I give $10,000 anonymously." But But the truth is that, look, you and I dare say everybody on this call has been incredibly lucky. And you wouldn't be on this call if you didn't have some money to worry about putting to work. And if you have some money, then you're lucky. And I think it's extremely important to share. I think about luck a lot. I think luck is very important. I think I've been incredibly lucky, and I think it's my responsibility to share and pay back that luck to others. There was an ancient Roman philosopher, Cicero, who said that the thankful heart is not only the parent, is not only the greatest of all the virtues, but it's the parent of all the other virtues. And I think that's very important. There is nothing more important than gratitude. And those of us who have benefited, whether it be through help from our parents, our friends, our partners, or society, or just good luck, those of us who have benefited owe it to others, to ourselves even, to appreciate that and pay it back. And appreciation, gratitude, or as Cicero would say, the thankful heart, is enormously important. And if you think about it, if you have, but don't appreciate it, then you're no better off than someone who doesn't have. And so I don't want to seem self-righteous, but the more we give, the better we feel. And I'm sure that all your listeners will share that sentiment with me, and I hope they'll share in that activity.
Well, amen, Howard. I hope that makes it to one of your memos one day. That is incredibly profound and much appreciated. First of all, I want to thank you and everybody for attending and participating, listening, sending in your questions. We had over 50 questions that people asked, and you were incredibly gracious with your time and all your wisdom. Thank you for being such a great philanthropist. If people are interested in helping out, the many Jews in need, as Jay highlighted, there's a lot of older Jewish people in this community that can't afford food and hospital care, many that are struggling in their businesses. The Jewish Federation is really the safety net for those people. And if you go on to jewishla.org, very easy to remember. There are many, many ways to give, or you can follow up with me or Howard or any of the folks that are involved. So it's jewishla.org. Howard, I look forward again to maybe one of the great break the fasts you did at your house, and spending time with you and Nancy and the family. And again, much, much gratitude for you and the time you spent and your wisdom. So thank you.
Say hi to Lisa.
I will.
And good luck to everybody.
Thank you. Thank you, everybody, for participating. We really appreciate it. Bye-bye.